Is the market crashing? Should you exit all your positions, switch off all your strategies? And is it really Trump to blame for all of this? Hey traders and investors, I know fear is real. The markets are tanking. Every day you hear a doom story. And you might be wondering, is this the big one? But before you hit the panic button, let's walk through what's really going on. And I will give you a practical roadmap of what to do going forward. So let's start with a simple question. What is volatility? There are many articles on the subject. Here is one from Investopedia. And basically, the VIX is a statistical metric that measures the implied volatility of the S&P 500 using options. Basically, the VIX index takes all the options that are traded on the S&P 500 index and gives us a measure of how wild are the price swings. Now, why the VIX index is so important? Because it measures the volatility on the S&P 500 index. And the S&P 500 index represents 80% of the US stock market valuation. And recently in my community, I shared this post where basically it shows the US represent almost 50% of the world equity market. Not only that, the next biggest stock market is in China, and the US is 4 times as big as that. And it's also 4 times as big as all European stock markets combined together. So that means that the S&P 500 index represents almost 40% of the world global equity market valuation. And it's no surprise that it is the most popular index, with many derivatives that trade based on that index. So it is true that when the VIX spikes, it doesn't only affect the US, it affects the whole world. Now, even though it represents how much fear is in the market, so when it spikes, usually it means that the market is tanking, but not all assets will be tanking. So yes, the S&P 500 index will be going down, but a lot of futures market can and will go up during that time. Notice I said when the VIX index spikes, and that is a vague measure, so we need to define what is high volatility and what is low volatility. This is a chart of the VIX index on monthly bars. So every candlestick here represents 1 month. Now, in general, the VIX considered high if it is above 30. So on this chart, I drew 2 lines. The red one is 30 and the green one is 24. So when the VIX goes above 30, that means we are in a high volatility regime. And when it goes down below 24, it means we have passed the volatility period and now we are in a quiet period. Here is the full chart of the VIX index since 1990. And as you can see, we have penetrated the 30 level multiple times. But we also noticed that it's rarely a single time occasion. So basically we go into volatile period and then quiet, volatile, quiet, volatile, quiet, and so on and so forth. So when volatility comes, usually it comes in multiple periods. So just by looking at the chart, the first conclusion is that the volatility is part of the market. It is not an outlier event or a crisis event. Volatility is built in the market. We go through seasons of nothing happening, and then volatility is spiking, stays for a while, and then we go back to nothing is happening. So regardless of why it starts, in this case, everybody's blaming Trump and the tariffs, but in fact, volatility is part of the market, and we usually see it almost every year. And to prove my point, let's look at some data. This chart shows you how many times we spike above 30. And since 1990, it happened 20 times. And you can see that it's almost every year. The only time we went many years without a spike is between 1990 and 1997. So that's 6 years where we had no spike. Otherwise, almost every year we have a spike, and sometimes twice. So in 2000, we spiked over 30 twice. In 2011, we spiked over 30 twice. And recently in 2018, we also spiked twice. This chart shows you the level that we peaked at during each spike. And we have only 3 years where we spiked above 60. So 2008, we spiked above 90. And in 2020, we spiked above 80. In 2024, we spiked above 60. And currently, as I'm recording this video, which is the middle of April, we already spiked above 60 so far. So this spike is not in the data that I'm showing you because the month didn't end and we don't even know if the volatility is going to go even higher. The next chart shows us the months where the VIX spiked over 30. So all months are represented except for June and November. On the other hand, 6 of the VIX spikes happened in August and 3 of them happened in December. This chart shows us the spike value in buckets. So the VIX between 30 and 35, it happens 5 times. Between 35 and 40, it happens 5 times. Like I mentioned, currently we are above 61. So this happened only once in the past 35 years. And we do have 2 times where the VIX spiked above 85, between 85 and 90. A big part of the VIX data is how long it stays when it shows up. So the first rule is when the VIX spikes on monthly terms, it never returns in the same month to quiet. So right now we are in April 2025. The VIX spiked in this month. So at least we have another month till the VIX goes to quiet terms. So this chart shows us how many months it takes until the VIX go down below 24. So 8 times when the VIX spiked, it took 2 to 4 months to go down below 24. 6 times it took 5 to 7 months. And on the extreme side, we have twice where the VIX took 70 to 20 months to go back to quiet. Again, I want to stress this point because when the VIX spikes, it will never go down immediately. Usually, on average, it takes 2 to 4 months, but sometimes, as you saw from the chart, it takes literally about 2 years. This chart shows some correlations, although they are anecdotal points. So twice when the VIX spiked above 85, it took 14 to 20 months to go back to quiet terms. Other than that, there is actually not a lot of data to extract from this chart. And even though the VIX can take from 2 to 20 months to go back to quiet levels, it seems there is a theme where the S&P 500 will make positive returns during that period. And remember, the chart we have is since 1990, so we're not looking only at the past 10 years. Here are the returns from the time that the VIX spikes until it goes back to quiet, measured on the S&P 500. So this is a visual representation of how that looks like. So I measure the returns and the drawdowns from the time the VIX spikes above our level, which is 30, all the way when it goes back to quiet, which is below 24. And we measure close to close of the returns and we measure the biggest drawdown. So 3 times when the VIX spikes, the S&P 500 showed a negative returns. 0 to minus 5% is 1 time, and above minus 10%, which was 14%, it was also 1 time. And 17 times it was positive. And twice of them were above 40%. So since 1990, with all the crises and the crashes we had during that period, if you follow the data for the VIX, every time the VIX spikes and goes back to below 24, which is the quiet period, we actually, most of the time, will see a positive return in the S&P 500 index. Now, even though out of the 20 times that the VIX spikes, only 3 of them, the return was negative, but the drawdown is a different story. So 12 of the VIX spikes had between 5 and 15% drawdown. 4 of them, 15 to 25. 2 of them had a drawdown between 35% and 45%. Okay, now that we understand what the VIX is and we look at the data points and it's normal and part of the trading markets, and usually it means fear in the market and long-term storm. So now let's talk about how to protect our capital and how to profit from these periods. For discretionary traders and investors, VIX usually means the market is crashing, but not all markets will be crashing. Also, as we saw from the charts, most of the time you will end up with a positive return on the S&P 500 index, which of course will be reflected on other indexes. So if you can handle the volatility, the best place is to stay because you're already now in a crash. The VIX has already spiked, so you're already too late. But if you cannot handle the volatility, then it's best to exit and re-enter again when the VIX on the monthly scale goes below 24. For active discretionary traders, the best choice is to stop trading, mostly because you are inexperienced and the high volatility will wipe your account very easily, especially if you are taking a lot of leverage. And if you feel that you cannot stop, you have to trade, so at least you should treat your capital as 50% of the original capital. So instead of taking leverage 30 to 1, 50 to 1, you should take leverage now 0.5 to 1. That means if you have $1,000, you should treat it as $500. This way you can, scratch your itch, whatever it is, but you can at least hold your capital and survive this period. Now, for systematic investors, my kind of people, you need a system to follow during those periods. Those systems need to adjust allocations based on multiple variables, and of course, one of them is volatility. And this is what my service TA portfolios offer. They are multiple portfolios, but they all have a logic to change the allocations to different assets. For example, the Quad Edge Momentum use multiple assets with different allocations based on different volatility measures. And as you can see, even though we had spikes in almost all the years, the returns are really good. Almost all those types of portfolios use some measure of momentum and volatility to shift the allocations to better assets. And when there are no assets performing, those portfolios usually will go to bonds or cash. Now, if you are managing big capital, then you need to diversify out of these assets also. So you can own farmland through ETFs. You can own, of course, real estate, again, through ETFs. And of course, crypto buckets or angel investing. All those will diversify your portfolio. Now, for systematic traders, you need a portfolio of low correlated strategies. That means you need long and short strategies, different time frames, different strategy styles, and different instruments. And you can include in your logic that when the VIX spikes, you can reduce your position size to half or reduce your strategies that you are trading to half. Of course, also you can build in your logic that you skip trading during volatile periods. That can be done through volatility filters. Doing all the above will make sure that you don't get whipped around with news or emotional reactions or price action. So the next time the VIX spikes or CNBC screams, sell all your positions, you'll know better and you have a plan of what to do with a calm head. And as a bonus for sticking around, I'll share this strategy that trades the VIX profitably in the next Algo Trader newsletter. I will leave the link for the free Algo Trader newsletter in the description below. And if you like this video, then you will love the next one.